Welcome to the Case Study Learning Series in Marketing Management by Skilled MBA. Today's case centers around Bajaj Auto, one of India's leading two-wheeler manufacturers, and its ambitious international expansion into Latin America, LATAM, and Southeast Asia, SEA. We'll explore how Bajaj has reimagined its strategy to overcome market challenges, build partnerships, and unlock growth in regions with dynamic consumer behavior and tough competition. As we navigate through this case, we'll examine the critical marketing, operational, and strategic choices shaping Bajaj's journey. Bajaj Auto, a dominant force in India's two-wheeler market, began its global journey with exports to emerging markets. The turning point came in 2021, when exports matched domestic sales for the first time, a clear marker of its international potential. The company set its sights on LATAM and SEA, driven by rising middle-class demand and an appetite for affordable mobility solutions. Bajaj's export-centric model and adaptability gave it resilience during the pandemic, but international brand recognition still lagged behind established competitors. Two key dynamics shaped Bajaj's expansion strategy: COVID-19 impact, disrupted global supply chains, and suppressed consumer demand in many emerging markets. Yet, it also led to a surge in demand for personal mobility due to concerns over public transport. Market dynamics: LATAM and SEA markets showed rising middle-class populations, urbanization, and interest in cost-effective transport. However, Chinese manufacturers expanded aggressively with ultra-low prices, increasing competitive pressure. Bajaj had a relevant product mix, but brand building and distribution posed new challenges. LATAM presented opportunities and challenges. Economic factors, currency volatility made pricing tricky, and tariff structures varied across borders. Consumer preferences: riders favored larger engine capacities and sportier styling. Brand loyalty leaned toward Japanese and American brands. Distribution challenges: the region's diverse geography and uneven infrastructure required strong, localized logistics and deep relationships. Competition: Honda and Yamaha dominated, while Chinese brands gained ground on price. Bajaj had to carve out a space that combined value, performance, and reliability. SEA was another high-potential region with distinct traits. Motorcycle density is among the highest in the world, particularly in Indonesia, Vietnam, Thailand, and the Philippines. Local manufacturing: Japanese brands had already set up production plants and dealer networks, raising entry barriers. Urban infrastructure favored smaller displacement, fuel-efficient bikes with storage options. Brand perception: Indian brands were often perceived as lower in quality, necessitating more brand education and performance demonstration. Bajaj's international playbook emphasized partnerships, partner selection, targeting distributors with market knowledge and local presence. Relationship building, focusing on transparency, shared objectives, and trust. Knowledge transfer, exchanging technical expertise for deep local insights. Growth expansion: expanding successful partnerships into assembly or JV models. This approach allowed Bajaj to scale fast, minimize risk, and build credibility with local stakeholders. Bajaj had to weigh two contrasting approaches: export model, centralized quality control from Indian plants, lower capital investment economies of scale, flexibility to enter and exit markets. Local manufacturing avoids import tariffs, reduces freight costs, enhances local brand image, enables quicker response to market shifts. Key decision factors included market size, regulations, cost, and supply chain readiness. Global expansion brought logistics complexity, shipping disruptions. COVID led to port congestion and container shortages. Freight rate volatility, fluctuating costs affected pricing strategies. Inventory planning, balancing stock availability with uncertain demand proved difficult. After-sales service: Timely spare parts delivery was crucial for reputation and repeat sales. Bajaj had to reimagine its logistics backbone for global responsiveness. Each region had unique product demands, region technical needs, consumer preferences, cost implications, LATAM, higher engine displacement, sporty styling, larger frames, moderate adaptation costs, Southeast Asia, fuel-efficient tech, compact design, ample storage, high adaptation costs, both emission compliance, digital features, connectivity, ongoing R&D investment, customizing product lines for regional demands required smart engineering and modular platforms. Bajaj faced a three-tier competitive structure. Premium segment, dominated by European and American brands like BMW, Harley-Davidson, and Ducati. Mid-range, stronghold of Japanese firms, Honda, Yamaha, Suzuki, with decades of trust and reliability. Value segment, crowded with Chinese brands offering ultra-low prices. Bajaj aimed to position itself between mid-range quality and value pricing, leveraging its Indian manufacturing efficiency and proven performance. International growth required careful financial planning. Investment estimates. Each market required multi-million-dollar commitments for partnerships, product localization, and supply chain setup. Expected returns. CA offered faster returns due to high demand density. LATAM offered longer-term but larger volume potential. Break-even timelines varied significantly, ranging from 3 to 5 years, depending on regulatory ease and consumer uptake. A phased entry strategy with controlled risk was critical. Expanding globally also meant navigating political uncertainty, policy instability, shifting import laws, and unpredictable tariffs complicated pricing and planning. Customs complexities, clearance delays, and inconsistent documentation slowed time to market. Evolving standards, emissions and safety standards were tightening, requiring agile R&D. Corruption and informal payments. Some countries posed ethical and reputational risks. Regulatory intelligence and local legal support became core enablers of market success. Rakesh Sharma, executive director, faced 4 big leadership challenges: vision alignment, balancing India's domestic priorities with international ambitions; talent development, building cross-cultural management teams with global experience; innovation management, localizing products while controlling costs and preserving performance; partner relationships, creating trust-based, long-term collaborations in complex markets. His leadership would define whether Bajaj could scale like a multinational while retaining the agility of a startup. The path forward focused on 3 key pillars. Market prioritization. Focus on Colombia in LATAM and Vietnam in C, both with favorable demand, infrastructure, and regulatory climates. Use them as regional springboards. Product strategy. Develop region-specific models, balancing local appeal with cost control. Strengthen local R&D. Begin testing electric two-wheeler concepts in C cities. Partnership evolution. Shift from distribution only to joint ventures and local assembly. Share technology responsibly while protecting core IP. To conclude, Bajaj Auto's international growth isn't just about moving products, it's about building presence, trust, and adaptability. Its strategy must carefully balance standardization with localization, speed with sustainability, and risk with resilience. LATAM and C offer massive potential, but success will require long-term commitment, deep partnerships, and regionally attuned products. This has been the Case Study Learning Series in Marketing Management by Skilled MBA. Thank you for joining us.